Hey folks, great to be back again. I'm Rajeev, managing partner at Orias Venture Partners, a VC fund with 95 startups that we've invested in. We have 3 unicorns already and 3 more on the way, given the explosive tech IPO market India is now becoming. So all good as 2022 starts. Today's guest is Jeff Snider, Chief Investment Strategist at Alhambra Investment Partners and one of the most articulate gurus on the bond market. This is particularly topical as we start 2022 with this big upswing in yields, fall in bond prices, coupled with the Fed distinctly getting into a tightening mode, both on the balance sheet front and on the interest rate front. Particularly scary for asset markets. So Jeff, I think we are all ears today to hear you and listen to what you have to say. Jeff authors and publishes numerous in-depth investment reports that sometimes run contrary to the established opinion. I think it's most of the time, Jeff, but sometimes. In early 2009, whilst markets and conventional wisdom were near perpetual gloom and doom, his reports provided a comprehensive review of factors that were leading to the market's resurrection. And lo and behold, resurrection actually happened. Currently, Jeff is published nationally at Real Clear Markets, Zero Hedge, and Yahoo Finance. In this talk, Jeff, I think will do 3 things. I'm sort of, front running him here. He first talks about bond markets and why following them gives us the best inkling of the future. He discusses deflation, inflation. I mean, this is the last week was when US showed a 7% inflation trend, almost a 40-year high. And he talks about how, he talks about why this is actually deflationary. So I think, that's one thing that's going to be there. And then he talks about how this will affect other asset classes as well. So, obviously, once all of this happens, how will the other markets change? So that's sort of where it is. I'm really looking forward to this, this speech, this conversation. So I'm going to hand it over to Jeff for about 30 minutes. Jeff, feel free to take a little longer if you want to. Folks, you don't need to make any notes because we are happy to make this conversation as well as the slides available after. After this, we'll move to the Q&A discussion. So please do type your questions on the chat. We'll definitely get to them. I look forward to a productive 60, 65, 70 minutes, whatever it takes. And, I think it's Jeff, over to you.
Well, thanks, Rajeev. My pleasure being here. And thank you for inviting me on. I think as you pointed out, yeah, my opinion does most of the time run contrary to the mainstream. I suppose there's a few cases here and there where I tend to agree, but a lot of the time it's unorthodox commentary and unorthodox analysis. And a lot of it has to do with the monetary system, which is my particular focus. And so that gets into any number of tangential topics and potential hot takes of points of interest throughout the economic and financial community, including, of course, as you just mentioned, inflation versus deflation. And in this day and age and at this time period, entering 2022, we're wondering, how can anybody be deflationary or think about disinflation when the US CPI, European CPIs, all these inflation measures around the world have hit multi-decade highs. So how can it be anything other than inflation? How can it be anything other than, say, the great inflation 2.0? Who do we look to find answers and clues about what's really going on in the system? And as we'll get into here, inflation is always and forever a monetary phenomenon. So it makes sense that if we're trying to analyze and sort out inflation, we should probably look at the monetary system. But lo and behold, what you find is that there's really not much, there's really no way to do that, because the Eurodollar story, or this global monetary story, the global reserve currency story that is the Eurodollar, shows that the monetary system became very complicated, and so much complicated that central banks don't even pay much attention to it anymore nowadays. Central banks aren't really central banks. They aren't in the money business. So if we're trying to figure out inflation, we can't go to central banks. We can't go to econometric models that they employ to try to analyze the economy. If we're looking for the monetary system, where do we look for clues? We have to go to the monetary system itself. And that's really where the bond market comes into it, because the bond market is made up of all of the financial entities out there that make up the actual monetary system, this Eurodollar system globally. So we have to be able to sort out what the bond market is telling us about the monetary system, first of all, and what that means as far as the real economy, real economic variables like inflation. So we start out with huge inflation levels, but what does the bond market say about it? And how do we know that the bond market has actually been a pretty useful tool insofar as sorting out inflation? So let me open the slide deck here, and we can start with that. Okay.
Great.
So
Technology works, Jeff.
it's fantastic, right?
Absolutely, yes.
All right. So inflation versus inflation. What are we talking about here? Well, inflation is obviously the acceleration or the growth or the increase in consumer prices. And we're talking specifically about United States inflation in this presentation, but it's not just about US inflation. It's not just about the US CPI, because there is a global inflation element to everything. And so what do I mean by inflation versus inflation? When we look back historically, we look at consumer price indexes or consumer prices in general. What we find is that there are times when consumer prices can increase for reasons that are not monetary in nature. So inflation, monetary phenomenon, quote unquote inflation, consumer prices accelerating and staying high for other reasons that aren't money. So therefore, it's not really inflation, it's something else going on. And so there's been a debate, especially recently, but it goes back about 10 years or so. If you remember back in 2010, 2011, the last time we had this real inflationary scare, all sorts of academic and mainstream debates about, well, what's the best way to predict the CPI? When nobody stepped back and said, wait a minute, are we trying to predict the CPI or are we trying to predict inflation? Because as I just said, there are time periods when consumer prices can increase that have nothing to do with inflation. And if it's not real inflation, if it's not real monetary expansion, the old adage of too much money chasing too few goods, that's inflation. And if it's not that, then what is driving consumer prices? And if it's not monetary inflation, then consumer prices can accelerate for other reasons. But if they do, it's not going to stick around. It's only ever going to be temporary, because without the monetary expansion behind it, there's no way for consumer prices to continue to grow continuously. And so we go back in time. I'm using again, US history, US CPI, for example. There's numerous episodes before the 1950s or before the 1960s where you find that, especially in that post-war period, the period right after the Great Depression, there's just three particular instances where consumer prices in the United States, as well as around the world, but particularly in the United States, consumer prices accelerated very rapidly. One particular episode in 1950 and 1951 associated with this beginning of the Korean conflict and the U.S. entry into it. And what we saw back then was consumer prices in the U.S. drastically accelerated. They expanded by double-digit rates, far and above what we see today in the U.S., but there was no money to it. It was entirely a supply shock. And that's really the other case of quote unquote inflation, where it's not a monetary expansion, but rather the inability of the rigidities in the economic system that don't allow for changes in demand to lead to a more subdued consumer price environment. Simple economics, supply versus demand. If the demand curve is relatively inelastic for given changes in demand, then what you find is that prices have to adjust. If everybody starts buying consumer goods at once, it's not as if producers can ramp up production right away. So if there's this rush of everybody to buy, whatever it might be, the only way that can be absorbed by the economy is in price adjustments. So we saw in 1950, right after the consumer conflict, Americans in particular, who had just gone through the World War II experience, decided, look, we know what's going to happen. The U.S. is going to enter the Korean War, and that's going to lead to all sorts of rationing and government restrictions. That means that we can't buy anything. So for a 6 or 7 month period there in 1950 and into 1951, Americans just bought almost everything they could possibly buy, a true demand shock, which the supply side of the economy could not keep up with, and thereby consumer prices across the board accelerated. But this was not inflation. Again, this was mostly a supply shock because, again, there was no monetary increase, no increase in the monetary system commensurate to the level of supply. So what we saw then was a temporary or transitory acceleration in consumer prices that didn't last beyond early 1951, because again, it wasn't real inflation. It was simply a supply shock. And so what we find then is that in the pre-1955 era, especially in the period right after the Great Depression through World War II and then the early 1950s, inflation or consumer prices had behaved very differently. And from the middle 1950s forward, even to today, or around 2008, the last decade or so, consumer prices have behaved very differently than they had beforehand. And so if we go to, again, the question is, how do we know if it's inflation or if it's a supply shock or what's really going on in the real economy? How do we know what's going on in the monetary system to decide whether or not it is inflation? And as I said at the outset, we turn to the bond market, which in the United States, obviously, is the U.S. Treasury Department, the U.S. Treasury market, where we can analyze especially long-term bond yields, because as Irving Fisher showed more than a century ago, long-term bond yields are nothing more than a combination of growth and inflation expectations. So if the bond market is saying, if it's, all of the banks and financial institutions and investors that make up the Treasury market in particular, if there are forces, if they see the monetary expansion, it leads them to believe that growth and inflation in the, not just the near run, but the intermediate and longer term are going to be an issue, then you would expect bond yields, as Irving Fisher said, to then behave as if inflation is going to be a persistent, continuous phenomenon. So long-term yields, therefore, do a very good job of sorting between what is real monetary inflation and what is the other types of inflation, the other types of factors driving consumer prices that are not money and therefore going to be transitory. And as I said before, look, here's a perfect example. We see the chart I'm showing you here, where we have these post-war supply shocks, one after another, 1, 2, 3, especially the one in 1950-51, where the bond market essentially ignored, because bonds were saying that this was not monetary expansion leading to consumer prices increasing, therefore a continuous acceleration in consumer prices. These are temporary supply side factors, which will at some point dissipate and it won't lead to inflation, persistent levels of inflation. So transitory, non-economic, non-money inflation, bond yields do a very good job of sorting out which is which. And as you can see in the chart I'm showing you here, we get to the 1950s, the middle 1950s forward, as the BLS was saying in the chart, in the slide I showed you before, something changed in inflation. We went from these supply shocks, non-money, to by the middle 1950s, and of course into the 1960s and 70s, where inflation had become a persistent phenomenon. And what you see is, lo and behold, bond yields did anticipate that regime shift from supply shocks, post-war, post-Great Depression, disinflationary conditions, to suddenly where inflation becomes a very persistent phenomenon that lasts, all the way into the 1980s. And so even in the early 1960s, where there was that period between the late 1950s, the middle 1950s burst of inflation, and then it kind of quieted down. And just before that period where we enter the great inflation in 1965, again, going back to Irving Fisher, what you see is that in the middle 1960s, around 1963, long-term bond yields, long-term treasury yields in the United States begin to rise. They're anticipating that consumer prices are going to start to accelerate and stay that way, because again, growth and inflation expectations grounded in the monetary system. So bond market participants in the middle 1960s started to anticipate this regime shift into what would become the great inflation. And it continued that way all the way through the late 1960s into the 1970s, where you can see the treasury markets, the ups and downs match the CPI almost perfectly, and even get into the 1973 oil embargo, which added to the consumer price index, but it didn't, again, that was another supply shock to add on top of the monetary expansion that was going on. And so here we see the treasury market, which once again does a very good job of sorting out what is inflation versus what is actually these transitory supply shock, non-economic factors, things like politics, things like that. But the overall point is that the U.S. Treasury market, as we saw in, from the 50s forward, did a very, very good job, very accurate job, not of anticipating the CPI, but of sorting what is and what is not inflation. Where do we see the monetary expansion of the persistent monetary expansion that would lead us into these inflationary periods? So before the middle 1950s, we saw these supply shocks. The bond market said, this isn't real inflation, so yields did not change all that much. And there's some, there's some factors that we have to consider there too, including the Federal Reserve was involved in the markets. But by and large, in the Treasury market before the middle 1950s, they shrugged off these supply shocks. Even though the CPI got into double digits in numerous episodes, the bond market was saying, not inflation, something else is going on. from the middle 1950s forward, especially from the middle 1960s into the 1980s, the Great Inflation, the bond market did a bang up job anticipating that regime shift and telling you ahead of time, hey, growth and inflation, especially the inflation expectations and long-term bond yields must be rising because we see yields going up in anticipation of what would eventually show up in the US CPI. So let's fast forward to the 21st century. So we're getting out of the 1950s and 60s, out of the Great Inflation. We're going through what economists had called the Great Moderation and getting into the early part of the 21st century. And then, of course, the Great Financial Crisis and then its aftermath. And what you see is that before 2007, in terms of bond yields, again, the Treasury market pretty much the same as it had been in that inflationary period from the 1950s forward, where Treasury yields do largely reflect changes in the consumer prices because, again, it's mostly inflationary factors or disinflationary factors of the Great Moderation, which are being factored into these long-term yields. But then we get into around 2007, where the first global financial crisis struck, and all of a sudden the bond market no longer really matches, as you can see on the chart here. Bond yields, the trend in yields don't really match consumer price increases. Again, in fact, if you look at it, this part from 2007 forward looks a lot like that first chart I showed, or at least the left part of it from those supply shocks of the 40s and 50s, where bond yields don't really match up with the CPI anymore, as if something has changed, as if the bond market is telling you in growth and inflation expectations embedded in long-term yields, as if we don't see the money part of the CPI anymore. It's not like there's a monetary expansion. In fact, in these three persistent episodes, or these three transitory episodes up to today, up to and including today, first in 2008, then again in 2011, and then finally in 2021, bond yields don't match the CPIs at all. In fact, again, as I said, it looks like the early 1950s where bond yields are completely ignoring the CPI, as if they're saying to you, number one, these are transitory episodes that don't have the overflowing monetary component to them that would make them into true inflation. So in 2008, when oil prices spiked, when other prices in the consumer price bucket in the United States and other places around the world went way up in the middle of 2008, the bond market said this is not inflation. In fact, the bond market was more worried about deflation than any inflation, because it was trading on what was actually happening in the monetary system, which was eventually became the global financial crisis. So 2008, no reason to chase the CPIs there, because it was sorted out in the bond market for us as not money, other factors beyond the monetary system, which meant that it was only going to be transitory. Of course, as it proved to be, very quickly by July and August of 2008, we saw CPI start to fall back because consumer prices, commodity prices, everything else were captured by the global financial crisis that bond yields had told you was coming. Then we had the immediate aftermath after the Great Recession and the global financial crisis, where again, everybody, mainstream analysis, money printing, the Fed finally going nuts with its printing press, that we were going to have a bout of inflation in 2010 and 2011. But as you see, especially into 2011, again, we have bond yields that are not matching what's going on in consumer prices, particularly US CPI. Instead, bond yields were telling you back in 2010 and into 2011, again, this is not monetary. This is not real inflation. So whatever's driving consumer prices in 2010 and 2011, a lot of it was just the rebound from the lows in 2009, but also there was some of the familiar factors we see today, including supply bottlenecks and other political factors as well. But the bond market had told you in 2011, this is not real inflation. This is not monetary. It's something else. Therefore, it's going to be transitory. So long-term bond yields didn't really pick up the CPI. So they weren't predicting the CPI. They weren't effective at predicting what was going to happen in the consumer price bucket. They were simply telling you whatever's going on in consumer prices, it's not monetary expansion, therefore it's not going to last, which it didn't. So we fast forward to 2020 and 2021, and we see the same thing again, where we have CPIs accelerate rapidly, the most rapidly we've seen in 40 years in the United States, as well as Europe and other places around the world. Yet bond yields barely budged. In fact, from their lows in August of 2020, long-term yields like the US Treasury, they aren't up all that much, including recently. especially not in any historical context, nor in any context that matches what's going on in consumer price. So straight away, we have this warning sign that, look, the monetary system or the bond market is telling us that the monetary system is not being inflationary. There is not an excess of monetary growth, regardless of what the Federal Reserve is doing. Therefore, what's happening in consumer prices around the rest of the world, in the United States, around the rest of the world, isn't that it's the same situation as 2008, same situation as 2011, not monetary expansion, consumer prices being accelerated for reasons that are, very familiar to the 1940s and 1950s, the supply shock. Which, I mean, I don't think that's surprising to most people watching us today, right, Rajeev? I mean, people understand that, especially in the COVID era, that there was an inelasticity to the supply function globally that created the conditions, the bottlenecks around the world, where consumer prices and producer prices in particular can accelerate that have reasons that have no reason, that have no relationship or no reasons that go along with the monetary expansion. So again, the original question is, how can we tell what's going on? Is it inflation or is it something else besides inflation? In the bond yield, the bond market, especially the U.S. Treasury market, but it's also global bond yields around the world, have done an exceedingly good job, not just throughout the history of the last 7 or 8 decades, but especially recently, the last 15 years or so, of sorting what is inflation versus what is non-inflation. So we don't use the bond market to predict CPI numbers. We use the bond market to sort CPI numbers. The bond market tells us, is this monetary expansion going to lead to actual inflation like the 60s and 70s? Then we would expect rates, long-term rates, to rise in anticipation of that. If it's something else like supply shock, if it's something like politics or anything like that, then we'd expect bond markets to shrug off what's happening in some consumer price indexes. And that in and of itself tells us that it's not actually inflation that's taking place. So as I said, inflation is always an everywhere phenomenon, but we have to be careful about what we're talking about, inflation versus CPI indexes, because there are times when consumer prices rise and accelerate for reasons that aren't money. But if it is money, then we see, then that leads us to actual inflation, which is a very different phenomenon, which tells us that things are going to be, consumer prices are going to continue, not just in the short run or transitory period, but they're going to continue over the longer term, in which, again, we expect bond yields to reflect that. So the real thing here that what we're really trying to work out is, is this monetary expansion? How do we know if or when the monetary system expansion? So then, how do we validate what the bond market is telling us as far as is this inflation or other kinds of inflation? And so that's where we really get into the Eurodollar story, which is a sort of a shadow money story, which is, we don't really have a whole lot of time to go through it here, but essentially the monetary system evolved and expanded in qualitative ways as well as quantitative ways, going back to the 1950s. And so we've had this global US dollar expansion outside the purview of the Federal Reserve and official central banks and authorities around the world. So we have this massive and rapid monetary expansion from the middle 1950s all the way up until 2007. But it's not reflective in what central banks have been doing, because central banks realized a long time ago that they don't actually control the monetary system. In fact, they realized they can't even measure or monitor the monetary system, because what the global banking system had been able to do as far as stretching the definitions, the use of monetary forms all throughout the world. So very briefly, we had monetary evolution that changed the way in which money worked in the real economy, as well as how central banks operate, or at least attempt to operate monetary policy. It's not really monetary policy anymore, so much as an expectations policy. So bond yields, again, are our window into what's going on in this shadow monetary system, because they're the financial firms, the banking system that is operating in the monetary system are the same ones who are trading treasuries based on the conditions they see that we cannot. So the bond market and long-term yields in particular are our window into this shadow money world. And so since 2007, 2008, almost it's, from the mainstream view, paradoxically, it seems like the Federal Reserve has rapidly expanded its own balance sheet. You see that in the level of bank reserves, systemic bank reserves in the US dollar, which everybody interprets as there's the money. There's the money printing that must lead to inflation. When the bond market, again, has already told us, well, no, the level of bank reserves goes up. That's what the Fed is doing, but that's not what the monetary system is doing. In fact, these two things are actually reactions to the same thing. When the Fed raises the level of bank reserves, it's not actually printing money. It's reacting to disinflation or outright deflationary money in the shadow money system that you cannot actually observe. So again, the bond market not only sorts CPIs for us, it sorts what is and what is not money in any really effective sense. So this is where I think a lot of confusion comes into the inflation idea, because you can see the Federal Reserve's balance sheet expanding. You can see the creation of trillions upon trillions of bank reserves. And we're taught that, the Fed is the central bank, it prints money. Therefore, if the level of bank reserves goes up, that must be monetary expansion. And the long story short here, the bond market tells us, no, this is not monetary expansion. In fact, the level of bank reserves going up is simply a reaction to monetary contraction. That's why long-term bond yields in the US and around the world tend to be low over these periods, especially since 2007, because the market is telling you, it doesn't matter what the Fed does, it matters what happens in the monetary system in ways that you cannot possibly see, or at least we can't observe it directly. So long-term yields, the Fed expanding its balance sheet is a reaction to the same thing that is keeping yields low, which, if you remember your Milton Friedman, the interest rate fallacy. I think that's another misconception people have about the monetary system, especially central banks' role in it. We're taught that, look, low interest rates are stimulus, and it makes kind of some intuitive sense, right? Because it seems like if interest rates are low and the Federal Reserve, at least it says it controls interest rates, and if it wants rates to be low, that makes it cheaper to borrow. Therefore, it's more credit flows through the economy, which tends to be inflationary, at least in theory. But as Milton Friedman pointed out in the 1960s, as the great inflation was taking place, no, low interest rates, especially in long-term yields, are a sign that money has been tight, not loose. And think about it historically. We just went through the history of long-term bond yields. Before, in the Great Depression, the 1930s in the United States, around the rest of the world, people may not realize that interest rates during the 1930s were low and went lower, tight money. Because whenever you see that the demand for safe and liquid instruments like treasuries goes up, that tells you a lot about what's perceived as far as safety and liquidity in the monetary and the financial system. So if there's high demand for only safe and liquid instruments, therefore bond yields on those safe and liquid instruments going down, as Friedman said, that's tight money, not loose money. Conversely, you go to, as we just did in the 1960s and 1970s, when money is loose, when it's actual consumer price inflation, when we see too much excess, we see excessive money chasing too few goods, what happens to the yields on safe and liquid? They go up because the demand for safe and liquid in a nominally inflationary environment goes way down. So conversely, in the 1960s and 1970s, interest rates rose. In fact, they got into the double digits by the late 1970s. So we can tell, again, bond markets, low interest rates, monetary system, all of these things are connected. It doesn't matter what the Federal Reserve does or the ECB or any other central bank around the world. What does matter is the monetary system itself. We do have some ways of peering into the money system and getting us some kind of sense of what's going on in it. And, not to get into too deep into the weeds, but what we're seeing in the monetary system, the shadow Eurodollar system, again, exponential growth, as I just talked about, up until 2008 in Bear Stearns. And then ever since 2008, it's been sort of contraction, sideways, growing, not really moving all that much. So essentially a paradigm shift in the monetary system around 2007 and 2008, which again, matches up exactly with what we said, what I showed you in that one chart where the bond market has ignored these bursts, the outbursts of consumer prices in 2008 and 2011, and again in 2020, because there isn't the monetary expansion there for it. And we can see this in any number of ways, any number of data. It takes a little bit of work to interpret what we're seeing. Right here, we see the derivatives around the rest of the world, which is another sort of proxy for monetary expansion, bank balance sheet expansion. Again, paradigm shift right around 2007 and 2008. Ever since then, the monetary system, the banking system that creates the money that also trades in the treasuries, very different behavior. And even recently, despite what's gone on, again, we don't care about the Federal Reserve, but the Fed has done an exponential QE, hasn't led to any change in the actual monetary system itself. So again, low bond yields ever since 2007-8 correspond with tight money. And when we look into some of these shadow money spaces throughout the Eurodollar system, that's really what we see. Paradigm shift, monetary system change, no monetary expansion. Therefore, if we see consumer prices accelerate, as we did in 2008, again in 2011, and then 2021, it's not the monetary variety. It's not money expansion here that's going on. So it must be something else. So if it's not monetary, if it's not historic, real inflation, it's something else. What has it been? And again, as I said, something changed around 2007, 2008. That something was the monetary system itself. It changed. It was, the 2008 global financial crisis was not a temporary one-off event that had something to do with US subprime mortgages. It was a complete regime change in the operation of the global reserve currency, the monetary system around the rest of the world, because that's really what the Eurodollar is. The Bretton Woods system that took over in 1940s really had been undermined by this Eurodollar expansion, but really by its own inherent contradictions. So that by the 1950s and 1960s, when it really started to take off, the Eurodollar actually became, or at least undertook, all of the monetary functions of a reserve currency, even though by and large, most people thought that that was just the US dollar, these US dollars traded around the world. It was really a bank-centered system in which the Eurodollar expansion led to the wave of globalization that swept over the global economy from the 50s throughout up until 2007, which is why we saw earlier that regime change in consumer prices and inflation, because there was the monetary expansion through especially the 1960s forward that we see reflected in bond yields and CPIs matching up pretty well. And then the paradigm shift in 2008, which was the breakdown of the monetary system, a global dollar shortage that has been a persistent problem ever since. Because again, as I just said, the global financial crisis was not a temporary one-off event. It didn't have as much to do about subprime mortgages as everybody had been told. It was a breakdown or a complete regime change in the monetary system, so that ever since August of 2007, there hasn't been enough money, despite the Federal Reserve and quantitative easing and balance sheet expansion. The shadow money stuff that we don't see, that's what's been tight. That's what's been leading to low bond yields and really persistently low inflation rates outside of these temporary periods around, not just in the United States, but around the world. So again, not inflation, not money. So what's going on in consumer prices in 2021? Not really a whole lot of mystery here, because I think people realize that the COVID recession, lockdowns around the world, were a non-economic intrusion upon regular economic processes, which made the supply curve extremely inelastic. So that when demand started to recover after the recession, the supply system just couldn't keep up with the expansion in demand, or the rebound in demand, I should say. And then to add to those problems, we had the United States federal government essentially handing out free cash in the form of treasury market rebates to people in the United States, which they then spent on goods. So we had another expansion, or another shift in the demand curve with a relatively inelastic supply situation, which led to consumer prices, producer prices, commodity prices around the world that rose rapidly, not because of excessive money printing, not because of the massive QE that the Fed did. Again, the Fed's QE is a reaction to tight money that arose in March of 2020, but because of these non-economic reasons. So the bond market has told you all along, again, no change in the monetary system despite the Fed. This isn't excessive money since 2020. This is essentially the quote unquote inflation variety, which is nothing more than a classic historical supply shock. Which just leads us to more recent times, more recent weeks, when I hear everybody saying it all the time, but wait a minute, interest rates are now rising. So is the bond market starting to pick up on the CPIs? Is the bond market really starting to think about, well, maybe this is inflation? Has the verdict from the treasury market changed? Because As we saw just this week, the benchmark 10-year U.S. Treasury yield reached the highest it had been in almost 2 years. So, I mean, is this a significant regime change insofar as the bond market's verdict goes? And the answer is no, because what's changed recently is the Federal Reserve misinterpreting recent CPIs in the US and becoming extremely hawkish, which means that, as you pointed out at the beginning, Rajeev, the Fed is going to not only be winding down its quantitative easing, doing balance sheet changes, it's also going to be raising rates in the near-term future, probably as soon as March. So what we find in these hawkish cycles, or when we get into these rate hike cycles, is what Alan Greenspan described in 2005 as a conundrum. And the conundrum was essentially that we're all taught to believe, and Alan Greenspan certainly believed, that the Federal Reserve controls the short-term interest rates, which then controls all interest rates down the curve all the way out into the long run. So if the Fed starts hiking rates, then we should expect rates to rise all over the place. For one, because the Fed's hiking rates, but number two, we're supposed to believe that if the Fed believes in inflation, why wouldn't that be reflected in bond yields too? Because the Fed is all knowing and all seeing, at least in theory. But as we see these the conundrum that Alan Greenspan was talking about in 2005 has been repeated in successive cycles. And in fact, 2005 wasn't the first conundrum either. It was actually Alan Greenspan's third. And what I mean by conundrum is the Fed starts to think of, okay, inflationary pressures are starting to rise. Therefore, we see more inflation in the future. The Fed then needs to take control by hiking interest rates and adjusting its balance sheet, as it was doing, if you recall, just a couple of years ago, 2017 and 2018. We heard all of the same things that back then that we hear today. And inflation is going to rise. We have tight labor market. We have CPI's accelerating. Commodity prices are going up. Economic fundamentals, according to the Fed and according to mainstream interpretation, were all good. Therefore, the Fed was not only clear to resume its interest rate hikes, but also to become more aggressive. And so that's exactly what happened 2017 and 2018. The Fed started to raise its short-term rates, and the short-term end of the yield curve responded to those rate hikes, as you would expect, because if the Federal Reserve is offering a relatively higher rate in its short-term monetary programs, that gets reflected into especially short-term rates, which offer alternatives to what the Federal Reserve is doing. So the short-term end of the yield curve started to steepen, anticipating that hawkish turn in policy. But then you get into early 2018, especially the middle part of 2018, where you can see longer-term yields, especially the 10-year, 7-10-year, and out all the way to long bond, began to resist those short-term, the rise in short-term rates and the rise in expectations for future higher short-term rates. And what that did is it flattened the yield curve, which was a very good and very historic signal that the long-term end of the bond market, the monetary end of the bond market that was telling us there was no monetary expansion, therefore we shouldn't expect inflation expectations, were resisting those rate hikes. So you had essentially competing pressures. You had the non-monetary expansion, this disinflationary, deflationary outlook being traded in longer-term treasury yields. At the same time, the Fed, which pays no attention to the monetary system, was raising rates because of its econometric models, which has failed it time and time again. And where those things began to collide in the middle of 2018, as the yield curve essentially flattened out. But even though the yield curve flattened and the long end was resisting the mainstream interpretation of inflationary pressures, you still see that nominally long-term treasury yields rose, but they rose only very modestly when compared to what was going on in the short end of the yield curve, which was, again, that flattening. So by October of 2018, we had the highest 10-year treasury rate in 7 years, which was proclaimed widely throughout the mainstream media as some sort of definitive sign the bond market had changed its inflationary mind and was suddenly getting on board with what Jay Powell was talking about with rate hikes all the way into the future for the foreseeable time period, which wasn't the case. It wasn't that the nominal rates were rising at the long end that was important so much as the flattening of the yield curve, which was definitive in terms of our signal about inflation and growth and expectations moving forward into 2019 and beyond, which is exactly what happened. If you remember what happened late in 2018 into 2019, there were no more rate hikes. There was no inflation. In fact, just the opposite. So what we can learn from conundrum number 4 is essentially that the Federal Reserve can, by raising rates and can by making the bond market anticipate higher rates in the future, it can influence the short end of the yield curve, but it doesn't necessarily heavily influence, or certainly not for the long run, the longer end of the yield curve. And even if nominal treasury yields are rising, that isn't necessarily a sign the bond market agrees with inflation. That's just the bond market having to come to terms with the Federal Reserve shift into a rate hike cycle or a regime change in monetary policy. And again, as I said, we've seen this throughout the last 20 years, the last 25 years, where the Fed has an inflationary bias where it decides, hey, look, we need to raise rates because we think inflation is going to be a problem, rather than looking at these long-term bond yields and saying determining whether or not it is. And so in the middle of the 2000s, in 2004, 2005, it's the same general pattern as we saw in 2017 and 2018, where we go into this rate hike cycle. The Fed highly influenced of the short end of the yield curve, but has almost no influence on the long end, where the long end of the middle 2000s was completely disregarding this inflationary signal up until the point where these short-term rates sort of collided with the long-term rates. And so for a little while, long-term rates, nominal yields rose at the long end of the yield curve, but that wasn't the market saying that, inflation is about to be a problem in 2006 and 2007. It was simply adjusting to those rate hikes, to the rate hike cycle. And again, as in 2017 and 2018, the yield curve dramatically flattened, which was essentially Greenspan's conundrum, what he was talking about in February 2005 when he raised that term. So again, lesson to be learned from this episode, like 2017 and 18, it isn't if nominal rates at the long end rise, but if they rise and the curve is flattening, that tells you more about the Federal Reserve's rate hikes than it does about growth and inflation. So in the middle 2000s, the bond market was wasn't seeing the inflation pressures that were making Alan Greenspan's Fed raise rates throughout that period too. So bring this up to the present time. Has the bond market shifted its inflationary view? We've seen the highest yield in almost 2 years, as I said before, in the benchmark 10-year Treasury, which has been widely proclaimed as a definitive signal. But again, as we saw before in 2018, as well as 2005, and even go back to 1999 and 2000, these various conundrums, it's this conflict of interest rates. So the yield curve that acts as almost two yield curves, where long-term Treasury yields are reflective, again, of what Irving Fisher said over a century ago, which is growth and inflation expectations, but they also have to incorporate what's happening in the short end of the yield curve. So if we have, a rate hike cycle, the Federal Reserve is going to begin raising its, nowadays it's IOER and the reverse repo, along with this federal funds range, then the long-term yields are going to reflect that the increase in the short-term range as well. And that's exactly what we've seen over, go back to October. The short-term end of the US Treasury curve has risen, and we see that downward pressure or the resistance in the long-term rates, even though long-term yields, the 10-year, the 20-year, and 30-year have gone up, especially since the beginning of this year. So in the context of the inflation debate, has the bond market changed its view on inflation? No, that's not what has changed. You can see really clearly what's changed is the path of short-term rates and the anticipated path of short-term rates over the next year or so, which have changed in the same way as we've seen in 2018 as well as 2005. These conundrums where what has actually changed in the bond market is the influence of the Federal Reserve on the short term. It's not a change, it's not a regime change, it's not a shift in inflation expectations, certainly not a monetary change. So the bond market, by the curve flattening, is telling you that it's not inflation. Again, nothing has really changed in that regard. It's really just the Federal Reserve what has expecting to begin rate hikes at some point this year and then continue them for at least the near term. And I think you see that most dramatically in how the curve has flattened out, especially in between where these two conflicting factors collide, which is between the 5-year and the 10-year Treasury. So the 5-year, which kind of reflects more about what the Federal Reserve is expected to do in terms of rate hikes, where the 10-year is, again, Irving Fisher, almost exclusively growth and inflation expectations, considering what's happening in the short end of the curve. And so going back to around the middle of June, the 5-year, 10-year, as well as the longer end of the yield curve has flattened out in these same conundrum type fashions, which tells you the bond market, the long-term yields are still not seeing this as an inflationary episode. They're still not seeing the monetary expansion. The only thing that has changed is the influence on the short term by the Federal Reserve. And again, it's the same thing. We're just repeating these conundrums one after another. We go back to 2017, 2018, go back to 2005, and go back to the late 1990s. Again, the most important point isn't that long-term yields rise, but how they rise. If the yield curve is flattening, that's the sign, that's the very definitive signal that we're not seeing inflation change. We're only seeing the short end change, and that's monetary policy. And that's exactly, it's very different from how the yield curve behaved at the early part of last year. If you go back to January and February 2021, that's when you saw what we should be seeing today, where we see the yield curve, not only did nominal rates rise, but also the yield curve steepened, which was the bond market becoming a little bit more optimistic. Now that wasn't about inflation so much as it was that we were getting past the 2020 recession, and that the negatives, the contraction, the rebound from 2020 was starting to really take hold. And of course, you had the vaccines and the possible end of the pandemic become in sight. So if we were seeing the bond market actually shift to more optimism, relatively better growth expectations, in particular in longer term yields, this is what we would expect. We would expect the yield curve, not only nominal rates to rise, but also the yield curve to steepen. And so that really didn't happen, especially when yield curves kind of topped out, or the long-term yields topped out in the United States as well as around the rest of the world around February, March of last year. And ever since then, we've had all these persistent negative signals where, already at a low level, already telling us that consumer prices aren't actual monetary inflation. So something else must be going on in the system. And that something else tends to be less growth, less inflation expectations, regardless of what the Fed is doing, regardless of the Fed's balance sheet expansion, which is more disinflation or deflationary potential over the intermediate and long run. So even though long-term yields have risen over the last little while and are relatively higher than they were last March, the flattening in the yield curve is another sign that no, this is not inflation. In fact, growth expectations are being negatively impacted by something, and that nominal yields across the curve are only rising because we anticipate the Federal Reserve to raise interest rates, and only do so for a very short period of time before it might have to reckon with what's really driving yield, or what's really keeping yields lower. And if we start to, if you want to get into any inflation indications around the world, these various price indexes, whether it be trade focused or inside the United States or elsewhere around the world, you can kind of see why we're starting to see transitory inflation pressures. We're starting to see the downside, even though consumer prices, particularly in the United States and elsewhere around the world, China, for example, producer prices accelerated into October. Ever since then, even though the Fed has become more hawkish and more rate hikes are anticipated in the marketplace, it's not like the inflation has accelerated dramatically outside of the U.S. goods economy. So U.S. import prices that have changed, as well as U.S. export prices. We see it in the U.S. services economy, where outside of those specific transitory periods going back to July of 2020, as well as April of 2021, the inflation pressures outside of U.S. goods just aren't there. We see it in China, particularly after October, where producer prices actually tumbled significantly, which looks like maybe that's a regime change there. So even in consumer prices themselves, or producer prices, or prices around the global economy, we can see why bond yields have sort of taken the skeptical tone, even as short-term rates rise, that maybe inflation isn't going to last very long. Maybe this really is the quote unquote version of inflation, the supply shock. We're on the downside of the downswing of that supply shock, which leads us to, maybe less growth in inflation in reality than maybe you're hearing around the rest of the world. So the short summation here is bond market has done a very good historical job of sorting what is going on in consumer prices by telling us what's going on in the monetary system. And if the bond market looks at consumer price increases and thinks and says that there's money to it, then we would expect to see that traded in long-term bond yields. And it's not always specifically about nominal rates as much as it is the curve shape where nominal rates tend to be. So if we have low nominal rates and a flattening yield curve, that's very different than, even if nominal rates are rising, it's very different if we're seeing nominal rates rise and the yield curve steepens, which is, what we would expect to see if the bond market was changing into this more inflationary, aggressively inflationary stance. So no money, not really inflation. We're seeing the downside of inflation throughout the world, which, true to type, the Federal Reserve is raising rates as the economy seems to shift outside of any sort of inflationary potential whatsoever, which is essentially the flat yield curve. So that's pretty much it.
Thank you so much, Jeff. I'm just going to sort of run through some of the questions that I had. First point, I think I love the presentation because of a couple of things. Really, when you're able to sort of look at the market, so the essence of the financial market is if you're able to get an insight before the rest of the market gets, right? And hence take positions before the rest of the market is able to take positions, your ability to either protect wealth or, increase it, goes up dramatically. And to that extent, the fact that you're predicting something very different from what the market is, what the market is talking about right now, and the fact that if it turns out to be true, you're going to be, in a windfall mode, I think is an amazing piece. I think that's the first, interesting observation that I would sort of make, and that's one of the reasons why I loved your, conversation per se, right? So if we were to look at the yield curve right now, I mean, I would interpret the short end of the yield curve as a response to Fed, so it's a Fed side of the yield curve, as it were, and the long end of the yield curve is the market side or the economy side of the yield curve. It's basically, what happens to inflation, what happens to growth, those kinds of things, right? So I'm also assuming as a part of that actual numbers don't really matter. What matters is the relative distance between the short and the long end. It's the delta between these two that's more significant than the actual numbers. Is that a fair assessment to make?
That's it. That's a perfect way of summing it up, Rajeev. I mean, that's it exactly. And I think that, your point is a valid one too, is that there isn't a lot of attention paid to the yield curve, particularly how its shape changes all through history. I mean, most people are just taught, hey, when the yield curve inverts, it means recession or something. And that's the only time they ever pay attention to it. And as I said before, we're not taught how to interpret interest rates properly anyway. So there's almost like this mysticism around the yield curve where, as you just pointed out, there's a wealth of helpful information in it that it's not necessarily, oh, interest rates rise, that must mean one thing. If interest rates fall, that means another thing. We have to take into account where they're rising from or where they're falling from, as well as the curve shape. And you're right, it's the changes in it, it's the delta in it that really tells us a lot about what the monetary system is doing, and therefore what we can expect in not just real economic outcomes, but also financial outcomes too, because inflation isn't just about consumer prices, it's about a whole lot of things, including how you're investing.
Then as a consequence of that, and this was another thing that struck me, if the actual reality is that we are headed not towards inflation, but deflation, because that's what the long end is actually saying, right? And also the fact of the matter is that basically, the Fed is reacting in a way that's hawkish, it's committing the boo-boo of a century then. Is that something that that's also consequential, or am I reading too much into it?
Not at all. But, the problem is that the Fed does this repeatedly. As I said, this isn't the first time, it's actually the fifth. And, we only have to go back a couple of years. We go back to 2018. Remember, 2018, inflation, the low unemployment rate in the United States, inflation pressures in Europe. The ECB, they terminated their QE. The Federal Reserve was raising rates. And remember, the expectation was in 2019, there were going to be even more rate hikes because the Fed was even more hawkish when, the nominal rates, yes, they rose on the long end of the curve, but the curve flattened out so dramatically. That was the bond market telling you that Jay Powell was about to embarrass himself. And he did. Because you remember what happened in 2019. First of all, there was a Fed pause, and then the Fed cut rates. The Fed cut rates, which the year before, at least in the mainstream sense, was unimaginable. If you had said to somebody in June of 2018 that the Fed was going to be cutting rates in 2019, everybody would have thought you were absolutely crazy. Yet there it was in real time, real money, real market signals that were telling you the probability of the Fed having to turn around and embarrass itself were exceedingly high. And I know we didn't really get into other parts of the bond market, including things like Eurodollar futures, but other curves were in agreement too. It wasn't just the treasury curve. It was the monetary, the financial system up and down that said, the Fed has got this all wrong. The Fed is doing the wrong thing here. The global economy is going in the other way. It's not in an inflationary direction. It's going in a disinflationary direction. And as before, in 2018, the market proved to be correct, which if you're, again, 2019 turned out to be nothing like everybody said it was going to be, because nobody pays attention to the yield curve. Everybody just takes their economic cues from whatever central banks say or the financial media, and the financial media just basically regurgitates and parrots what central bankers are telling them anyway. When you have at your fingertips this wealth of real-time, real powerful, historically validated information that tells you a lot about what's going on in the actual system beyond what we can see.
So the next question, and this is counterintuitive, right? So your fundamental thesis is basically there's a tightening of money in the markets because the shadow market, shadow currency, Eurodollar system, and so on and so forth. And yet we are confronted with the data that in the last couple of years, something like 25% of all dollars that have ever been created were created, right? And the Fed balance sheet has significantly gone up, right? Obviously, I think you went to great pains to explain why that has not resulted in a lot of money flowing into the system, even though the fiscal policies resulted in a lot of money going to Americans in terms of checks, $700, $800 per week. I mean, I would love to have been in the US the last year, if you know what I mean, right? But so why isn't all this monetary expansion? I mean, in a short, a couple of sentences, why isn't this monetary expansion?
Yeah, that's again, as I said before, starting with bank reserves, you can see those increase and you think that's money. Everybody's taught that they even call it base money in certain circles, but the Fed would tell you, no, it's not real money. So bank reserves are not money. That's the short answer. And then as I say often, and I said before, it's not what you can see, it's what you can't see. Again, there's a reason why I call it shadow money, because this is untracked, it's unmonitored. We don't really have a direct window into the monetary system. So it may be that the Fed creates a lot of bank reserves, but that doesn't really matter. Or the federal government hands out free cash to people, as you were saying. But what we don't know is what's going on in the monetary system beyond those things. So it may be that the Fed creates a lot of bank reserves and the federal government hands out a lot of cash, that we can see those things and we thought, oh, that's a huge monetary expansion. But what we can't see may be monetary destruction. So March of 2020 in particular, we had a global financial crisis, a second global financial crisis, where we can plausibly infer tremendous monetary destruction. We didn't see that. So we didn't see the monetary destruction, which may be larger than the expansion in the federal government's activities, for example. And how do we know overall if the monetary system is expanding or it's contracting? And again, as I said, the bond yields are a perfect way, or not a perfect way, but a good way, a reasonable way to tell you what has happened. So even though we see monetary expansion, or we see what looks like monetary expansion, it's what you don't see that often matters. And that's where the yield curve stuff really comes into it. Because the yield curve is telling us, yes, federal government, Federal Reserve, all of these things happened, but it's what you didn't see happen that's probably important here. So it's the tightening of money. We can't really see that. We can't really observe that directly. And that's really what has mattered over the last 15 years.
Great points. Thank you so much. So I think, we have sort of come to the last maybe question of this. So two questions really in this. One is really, okay, so let's assume that everything that is happening, what the bond market is predicting in the long side of the equation is actually going to happen. The yield curves are flattening. That means basically growth is slowing, and hence inflation is slowing. That's really what you're saying is happening at this point in time. What is the implication of that to the world in terms of what happens? So, obviously we are all, very interested in what happens in India, because that's something that we are very excited about. So how does this translate, given that US is such a huge dominant force in the financial markets, and it sort of sets the tone for pretty much anything that happens anywhere else in the world? What do you think is happening, one, across the world? So geographically, where would you see this? Second is asset class wise, what does this mean to other asset classes? Does this mean that since the, yields are going to, tighten, or, they're not going to sort of rise too much, does it mean you pile back into bonds, pile back into dollars again? What are the implications of this?
Yeah, to taking the last part first, I think that's the implication over the longer run. You got to be careful long run versus short run, because in the short run, the Federal Reserve is going to influence certainly the financial media as well as mainstream interpretation of what's going on, and so that could have a heavy influence in the short run. So you got to be careful about the short term. But over the long, intermediate, and longer term, I think that's what we're looking at. Higher dollar values over the longer run, even if the dollar backs off in the short term. Because tight money, disinflationary, deflationary environment is associated with a rising US dollar exchange value, as you would expect with economic growth around the rest of the world sort of tailing off or slowing down, maybe a downturn or something like that. So rising US dollar, and eventually we'd expect, like 2018, like 2005 in the bond market, yields would eventually start to fall when we get past a certain point where the bond market says deflationary pressures certainly outweigh and reasonably outweigh any short run factors. Then what you see is not only the yield curve collapse, and it doesn't just flatten, you might even actually see inversion, which is exactly what happened in 2018 and 2019, which clears the way for, regardless of what the Fed says or the Fed does, interest rate bond yields can actually fall. So you have this sort of, no man's land between now and then, where nominal rates at the long end too can be pressured higher as they were in 2018, but eventually at some point the system breaks down and long-term rates start to fall. So there's always this sort of, you have to navigate the short run versus the longer run, where we're seeing, flattening yield curve means there's the potential for falling yields down the road, but between now and then you got to be very careful, because the Fed is going to be highly influential, especially at the short end. As far as other asset classes, there's really no one-to-one. There's really no quantitative formula you can follow that says, if this happens, then stocks do this. If this happens, then gold does that. And gold, as you know, Rajeev, is tied very, very well to real yields in the TIPS market, for example. And so real yields have risen because they're factoring not higher growth expectations, but as we saw in 2018, they factor the hawkish Fed policy too. So it's, TIPS have behaved in 2022 so far. Real yields have gone up, and that's not usually a short run positive for gold. But if the deflationary scenario does work out and the yield curve is as it was before, if it's being a useful predictive tool, then eventually we'd see real yields fall at some point as nominal yields fall. And that would be positive for gold, as it was in 2019. You remember, gold had a tremendous year in 2019 because of these deflationary, disinflationary, deflationary results that we're talking about now. So that's really the difficulty. We've got this short run sort of Federal Reserve hawkishness, and then what the bond market is telling us about the intermediate and long-term probabilities, which are kind of contradictory, conflicting with that. So it could be that asset classes behave one way and then behave in completely the opposite way down the road. It's really about navigating the short run here.
Got it. One quick question from Rajesh. I think India does not have a very deep bond market. I mean, as a predictor of the economy, how deep does the bond market have to be? I mean, can I say that I can take the learnings of what you've done in the US? I mean, obviously you may not be able to answer this, Jeff, because I don't know how much you know about the Indian market, but would it be fair to assume that what is happening there can be sort of, applied in some form or fashion to the Indian markets as well? What our bond yields are doing can, in other words, tell us what's happening in the Indian economy as well? Is that a possibility? I mean, is that something that could work?
Absolutely. And I think you can start with even just the US Treasury yield curve, because that tells you something not just about the US economy, but about the global economy in general. If not specifically India or China or other places around the world, it gives us a sense of what the global economic direction might be. And so if the global economic direction is, as the yield curve says right now, sort of disinflationary, maybe deflationary over the intermediate and longer term, certainly 2022 into 2023, that would mean some global headwinds for the Indian economy. And so does that get reflected into specifically Indian bond yields? I haven't studied that in any kind of depth and detail, but I would imagine as the Indian economy and the Indian financial structure starts to become more sophisticated and more developed, that you would see these Fisherian, Irving Fisher's, growth and inflation expectations and long, the division between the long end of the yield curve and the short end of the yield curve, which I do believe is heavily influenced by the Reserve Bank of India, right? So it could be that, I don't know if this is the case now, but I would imagine that at some point, as soon as the bond market develops beyond a certain threshold, whatever that threshold might be, you can interpret the yield curve in India in the same way you can interpret everything else. So the US Treasury yield curve is helpful for the global economy, giving the global direction. And then I think, specifically, as we've seen in countries around the world, not just India, where yes, China's a perfect example. The yield curve flattening there, which goes along with everything else that we're talking about as well. So, I think if you look at the yield curve and the way it's, the way it's talked about, the way you're taught to believe in it, you'll be confused and you won't understand what's happening. But if you look at the yield curve and the way it's meant to be interpreted, what it's actually telling you, whether it's the US curve or it's other curves, I think there's some fundamental underlying truth, regardless of geography or jurisdiction, that yield curves are yield curves wherever they are.
God, I think that makes sense. And it's like if there's a divergence between the yield curves, and that's saying that's stating a message by itself. Perhaps that's one way to look at it. But one further question that's come up: if the money tightening is something you said after 2008, we have gone into a tightening cycle, right? But then how does that explain the huge surge in asset valuations?
Yes, that's a question I get all the time, right? Because another myth, what we're taught is that, the Fed prints money and that money goes into the stock market, right? Or that goes into real estate, or that goes into all sorts of various asset classes. And if asset prices are rising, that must be money printing. That's a myth too. There's really no reason to believe that. In fact, we don't have a lot of time to get into it here. What the Federal Reserve in particular, but all central banks around the world really have had to do since the development of the Eurodollar system pushed them out of the money business is expectations. They try to manipulate expectations, which is essentially what monetary policy actually is today. It's not about printing money. Bank reserves aren't money. We just went through that. What the Fed tries to do is influence your behavior. So if the Fed is cutting its short-term interest rates, that is meant to be a signal to you that the Fed is being helpful. And if you actually believe the Fed is being helpful, you believe that the Fed's lowering of interest rates is accommodative, the Fed believes and economists believe that you'll act in that way. That if you think the Fed is being helpful, if you think the Fed is being inflationary, you'll act as if inflation is coming, which means they're influencing your behavior. Now, it doesn't work so well in the real economy, where the real economy actually needs real money to function, but it can work relatively well in certain financial markets, particularly the stock market, where behavior is pretty much everything. Because despite what we tell ourselves, stock prices aren't really anchored to any fundamental reality. That's why valuations can get so ridiculously stretched at times, because as much as we say earnings are the way we value stocks, they really aren't. Earnings are sort of a fiction too. So if the Federal Reserve can influence the behavior of those who buy stocks, for example, then the Fed can make stock prices go up. Essentially, I'm sort of oversimplifying here, but the Fed has a lot more influence over share prices, for example, in the aggregate sense, than it does over the real economy, which is why when it tries to influence everything by being accommodative, doing QE or lowering interest rates as it has since 2008, you see this major divergence. The real economy hasn't grown, while share prices have gone through the roof, because share prices can be manipulated by emotion, whereas the real economy can't. And that's really what explains why certain financial markets seem to be operating in a very different world than the real economy is, because it's psychology versus money.
And that, I think, is a great last word, Jeff. Thank you so much. As I said, remarkably prescient conversation. All of this turns out to be true, and we've acted on it. Then I think we are laughing all the way to the bank this year. So thank you so much for that, and look forward to having you back on at some point in time, and hopefully we'll get you to India as well. Thank you so much for everything. Appreciate
well, thanks for having me. It's my pleasure. I always enjoy talking to people, especially around the world, about the global monetary system and the bond market, interpreting yields, all that stuff. So thank you for the invitation.
Fascinatingly insightful. Thank you so much.